Is holding its Sub-Saharan Africa summit in Sandton, as you just mentioned. Moody's is the only major ratings agency that still has South Africa on a non-junk or investment grade rating. A downgrade could mean large outflows of investor cash and would send debt costs soaring. There's keen interest in the views of the agency ahead of a possible ratings change at the beginning of November. Let's get more on the story. We cross to my colleague, Glorious Sefako-Musi in Sandton. A very good afternoon to you, Glorious. What kind of a sentiment is coming out from Moody's about the state of South Africa's finances currently?
Good afternoon, Zinga. Well, you would understand that a lower credit rating would mean South Africa's, with its budget deficit and the need for borrowing from different institutions, would mean that we would pay higher rates when we go out to the markets to borrow. So that's a kind of a concern by most people that are here. But we've heard from Moody's that the stable outlook at which we are at now at Baa3. We would likely be there for a while, given that we are at a stable outlook, and after that, if we had to be downgraded, we would have to go to a negative outlook, but we are at a stable outlook for now. We've heard of concerns of Eskom, the situation at Eskom being described as very serious, given that Eskom is now requesting bailers from government, given that the debt levels that they are facing and its inability to provide electricity, uninterrupted electricity at affordable prices for businesses. We heard that on a more positive note, what is working for South Africa is the restructuring of and the restructuring of government institutions, strengthening of government institutions, which working more positively for government. On a more positive note as well, Moody's this morning released a report on the state of our financial institutions, our banking system, and they're saying that despite the difficult economic challenges that we face, we find ourselves in, the low economic growth levels, they've said that they foresee the economy this year growing at about 0.7% and 1.5% for next year. But our financial institutions are resilient. When to talk more about that, we are joined now by Akin Majegodumni from Moody's. Thank you so much, sir, for joining us. What do we attribute to the financial institutions, South Africa's financial institution, being resilient under these conditions?
Sure. So just to clarify, so this morning we published the banking system outlook, and the outlook for the South African banking system is stable. Now, there are a series of drivers behind that stable outlook, but in essence, we think the very low growth environment that you mentioned will constrain banks' lending growth, so their ability to grow their balance sheet. At the same time, we think it's going to put pressure on NPLs. So we think NPLs are probably going to rise from about 3.7% upwards, but no more than 4% over the next 12 to 18 months. However, we still see resilience when it comes to bank capital, we see resilience when it comes to profitability, and we see resilience in funding and liquidity. So those are the drivers driving the stable outlook.
You said that we'll see bad debt rising in your presentation earlier, bad debt rising, and the loan growth declining as well, and but profitability stable.
Sure. So just to give you more information, when we say loan growth declining, what we saw over 2018 was loan growth grow about 8%. We only expect a slight cooling of that growth rate to about 6%, so roughly in line with nominal GDP. Now, with NPLs going up, we do expect some uptick in the credit loss ratio for banks, so their cost of risk, but nothing significant. So we do think that banks will still be able to absorb most of this increase in the cost of risk with their pre-provision income. Now, the reason we don't think there's going to be an overall impact on net income or return on assets is the fact that over 2018 and 2019, we saw banks invest heavily in digital platforms. They spend a lot in terms of operating expenses in developing IT, developing software. We kind of think this has peaked now in 2018 and some banks in 2019, and going forward we will see a fall in this expense, and that should offset the pressures we see on net interest income in terms of the cooling we're expecting in terms of loan growth.
Can you just explain further as well? You mentioned earlier that we are seeing more banks closing up their branches. It's a phenomenon we've seen here in South Africa, and we've also seen banks cutting up their staff.
Yeah.
How is that working?
So basically, banks are evolving to meet the preferences of their clients. Clients want to do more, for example, via mobile banking platforms, via e-banking platforms. So banks themselves are becoming a lot more digitized. And this means that there's been a reduction in bricks and mortar, so branches, and also a reduction in the workforce at a few banks. So really the numbers that we've seen in terms of the number of employees at banks drop, that's kind of down to natural attrition. As employees want to leave, they're simply not replacing those employees. But this is all part of the strategy banks are taking to become more competitive in the market, especially given the given the fact that new challenger banks have come to the fore, such as Discovery Bank, Time Bank, and Bank Zero.
And also the issue of household indebtedness. How are we doing in South Africa?
So over recent years, we've actually seen household indebtedness fall. In 2008, household debt as a percentage of disposable income, I think, was around 85%. Now it's around 72.5% in terms of the latest data we've seen. So it has declined, but still overall it remains quite high, especially when we compare the South African banking system with other emerging market banking systems. 72.5% is still quite high.
Thank you very much for joining us. And Nzinga, that is Akin from Moody's joining us there, talking about the state of the financial system in South Africa. It's back to you.
Glorious Sefako-Musi giving us an insight into that Moody summit taking place. It's time for a short break. When we come back, I'll have more business news for you.